I think if you're waiting for Powell to cut rates or restart QE, and that is what's the signal to you to jump back in the markets, you might be waiting, and the rally, Bitcoin might be at 500,000 before you get that signal that, oh, okay, God, now it's time to do the thing like they did in 2008. I think we're going to get for a similar sort of move. I think this is our start to $1 million.
Arthur Hayes opens by debunking a persistent market myth that investors should sit on the sidelines and wait for traditional signals like rate cuts or a new round of QE before re-entering risk markets. According to Hayes, that mindset is outdated and rooted in the 2008-2019 quantitative easing playbook, a playbook that no longer applies.
Please take a little time to like this video, subscribe to the channel, and turn on post notifications for more videos like this. You can also check out our other videos on cryptocurrencies and the overall digital asset space and drop your comments and observations in the comments section below. Everything you do helps with the YouTube algorithm and immensely contributes to the channel's growth. Thanks and enjoy the video.
I mean, I think the focus on rate cuts is a bit silly because people want to look into the past and say, okay, we know what happened from 2008 to 2019. It was quantitative easing. We know what it means. We know how it was implemented. We know the communication throughput and how that happened. And so we were trained over, a decade of, okay, Fed prints money every week. We go and buy stuff and it goes up, right? And it's just that easy to make money in financial markets. But then obviously everyone caught on to the game, like, oh, this is inflationary. Quantitative easing means inflation. Inflation means I don't vote for the party in power. Therefore, it's bad to use the term quantitative easing. Like the normal people know what that means, which means it's time to change the game. And so people who were looking for QE missed 2022 and the end of the year when Janet Yellen wasn't technically QE, but it was very similar. Money was created in some way, shape, or form. And stocks, crypto, gold, everything ripped over the next 24 months, right? Up until the Trump inauguration. And now again, people are like, oh, when's Powell going to cut? When's he going to do QE? Okay, that's 2008, 2019 paradigm. Now we have treasury buybacks. Again, it's not as straightforward as quantitative easing, but it accomplishes the same thing, handing more leverage to those who can buy treasury bonds. There will be more trillions of them issued because the US government runs a massive deficit. Therefore, money will be created. Again, it's not as straightforward as 2008, 2019, but it's the same thing. So I think if you're waiting for Powell to cut rates or restart QE, and that is what's the signal to you to jump back in the markets, you might be waiting, and the rally, Bitcoin might be at 500,000 before you get that signal that, oh, okay, God, now it's time to do the thing like they did in 2008. So I think we need to be mentally flexible and understand that it really all boils down to volatility in the bond market. And the best proxy for that is the MOVE index. If you don't have real-time pricing, it's published every day at the end of trading hours in New York. And if you look over time, pretty much when it gets above 140, almost immediately policymakers do something. So April 8th or 9th, intraday hit 172. A few hours later, Jamie Dimon's on TV and CNBC excoriating Trump for this tariff thing. Trump immediately walks back tariffs. 2022 in September, MOVE is above 140. Janet Yellen shifts issuance of bills for bonds, and we start rallying. And I can go back over a bunch of other financial crises and show you 140-ish levels in MOVE. Policymakers immediately react. And that strike price gets lower and lower as the leverage increases in the system. And so Trump is a very volatile politician. That's his style. He likes to throw shit against the wall, see what sticks, and change. That means more volatility in the markets. Bitcoin loves volatility. We will do well. I don't know what the policy is. I don't care what the policy is. He's just going to try stuff. It might work. It might not work. We don't care, because at the end of the day, as long as volatility goes up, we make money, because we know that authorities cannot handle it because of all the leverage embedded within the financial system. It's just that simple. The Trump team took a maximalist position on tariffs, and that was thrown out the window with a week of bad market price action. And you had Trump walking back tariffs. Now he's even saying he's going to cut the China thing. You have Besson going on a tour of all the media outlets basically saying he's got a big ass bazooka and don't fucking doubt him. He's going to make sure the treasury market's all good. You have a Boston Fed governor coming out and saying they'll do whatever it takes to make sure the market is properly functioning. And so we know that the bottom is in. They caved. They couldn't handle the stress of dramatically quickly changing the global financial system. Not to say it won't change over the next, decades or whatever, but it's not going to happen in a quarter because these guys got to get reelected in 2026. So we bottomed. The money's coming. Bitcoin's up, but like 25% off the lows already. And if you think back to 2022, after the FTX lows, we rallied 6x when Janet Yellen took reverse repos from $2.5 trillion down to zero. I think we're going to get in for a similar sort of move. I think this is our start to $1 million. Price is what you pay, value is what you get. It's all about what price you pay. EtherFi 55 cents, outperforms Bitcoin if they do what Mike says they're going to do. EtherFi at some ridiculously high other price will not outperform Bitcoin from that point onwards if they do another billion of revenue, which is obviously much less percentage gain off of a higher base, right? I think so. Yes, anything can outperform Bitcoin. Is what price did you pay for it? And then what was the change in revenues over that time period? So I think that's how you have to look at it, not like in an absolute sense. Does this outperform better than Bitcoin?
If you're a central bank manager in Asia or the Middle East, how can you trust that your dollar assets won't be seized next? Hayes says this explains the massive gold buying by surplus nations. They're not dumping dollars overnight, but they're buying less treasuries and more gold, and eventually Bitcoin. This distrust is only compounded by rising U.S. deficits. Despite attempts to rein in spending, the deficit continues to grow, up 22% year over year, even with budget cuts and program reductions. Hayes makes the case that no political party will touch entitlements, which means the deficit trajectory is locked in.
And so I think a lot of these tokens that are, earning real revenues that are not sort of appreciated for that fact have the ability to outperform Bitcoin when we get the alt season or fundamental season or whatever you want to call it, when the Bitcoin dominance peaks in this part of the cycle, and then some of those tokens and projects really start spiking in price.
And before we get into alt season and everything that entails, would you say Bitcoin dominance has peaked for this part of the cycle?
No.
Okay.
I don't think so. I think that the folks who didn't get smoked in meme coins and all the other past alt season, obviously they're institutional investors or have family offices or high net worth, whatever it is, right? Because now Trump has shattered this illusion that there's this American exceptionalism, this paternalistic empire that's looking after people's capital, but is now just looking after the base voters who got this person into office. Then I think these people are going to start to understand why Bitcoin exists. They're going to start to appreciate gold more, and they're going to buy less NASDAQ, buy less treasury bonds, buy less bunds, buy less of everything, right? Because now there's this, oh shit, things are changing. I don't know what that change is going to mean, but I had it so good in the last situation. I might not have it so good in the next one. Let me buy something that is not correlated with the establishment persisting in its current form. If we want to take a look at when gold really started to catch a second wind here in this bull market, it's February 2022, when the United States government decided to steal the money of the largest commodity producer in the world. And basically they're saying these treasuries, things that you own, there's no property rights in America, there's property privileges. And you're allowed to own these things if we like you. And if you do something we don't like, then we're going to steal it. And they stole Russia's stuff, right? And so if I'm a central bank manager and I just watch them steal literally the largest commodity producer in the world, who makes the most, base things that help us live this civilized life, and the empire stole it, why do I want to own the claims of that empire? So again, I'm not going to go out and just dump all my treasuries because that's just dumb. Okay, well, if I'm generating more dollars on the margin, I'm going to be inclined to either buy stocks or buy gold, and that's what they've done. Pick your central bank who runs a current account surplus, and I'll tell you they're buying more gold than they ever bought in the last 20 years. That's the gold story. Obviously, Bitcoin has outperformed gold if you want to look back to 2008. But at the end of the day, I think you own gold because the central bank's going to buy gold. You own Bitcoin because the retail population around the world is going to buy Bitcoin. But what are they trying to escape? The same thing. Too much inflation, possible collapse of the fiat post-World War II financial system. The assumption is that the federal deficit continues to rise. Now, if you look at the most recent Treasury monthly statements of the U.S., the fiscal year, which starts in October, October to March of 2025 versus October to March of 2024, spending is up 22%. or the deficit is up 22%. So this is in the face of 2 months of Elon Musk's Doge, and in the face of all these government programs being canceled. The deficit is still rising. And so I make the assumption that it's going to continue to rise because that's just how the U.S. government has been structured. And, I don't care what stripe of politician you are, it's political suicides really go hard at some of these entitlements. You can cut around the edges. And as we've seen, Doge, they said they were going to do $1 trillion. Elon walked it back to 150 billion. And now he's out the door in a few weeks anyways, to go back and try to resurrect the Tesla stock price. So deficit increases. Who funds the deficit? We just talked about how the U.S. stole Russia's money. And if you're a central bank manager, we don't want your money stolen, so you don't make the problem worse. You don't buy as many treasuries as you would have bought otherwise. You buy other things. So we don't have foreigners buying at the margin. We don't have the Fed buying at the margin. They're actively reducing their portfolio of treasuries. And the private sector, people in America, are broke, right? They spent all the stimulus money on goods and services, and that economy the money is run out. So who's left? Well, these hedge funds showed up, starting in mid 2022 with a basis trade, which is I buy a cash bond, I sell a futures contract, I earn a bit of a spread, I highly leverage that trade, and I make good money. Now the more leverage I have, the more I can buy. And so that helps the Treasury fund itself because they don't really care what the yield is. They're going to buy the bond because it's trading at a discount to the futures implied price. So if Bessent can allow these group of individuals to buy more at auction, then he can increase the issuance of bonds. I mean, he has to increase the issuance because the deficit continues to rise. So that's really the mechanism here. As long as they can provide this balance sheet that sits in the banking system by changing the rules or alleviating some of the stresses, then these group of hedge funds can buy more bonds at auction at prices that are affordable to the U.S. government. So that's the mechanism by which the Treasury buyback, which in and of itself adds no liquidity to the system, helps the well-functioning of the Treasury market and helps Bessent issue more bonds.
With foreigners pulling back, the Fed shrinking its balance sheet, and U.S. households tapped out, who will buy the growing mountain of U.S. debt? According to Hayes, hedge funds using the basis trade are the answer. These funds buy cash bonds, sell futures, and earn a spread, but their ability to buy depends on balance sheet capacity, which regulators like Bessent can influence. By loosening rules or providing indirect liquidity, the government can enable hedge funds to absorb more issuance. Treasury buybacks help facilitate this, not by directly adding liquidity, but by keeping the system from seizing up. Please like and subscribe.